Good evening, everyone, and welcome. Thanks for joining us. Well, stocks edged a little bit lower into the close today, but things didn't start that way. In fact, the Dow and the S&P 500 both hit record intraday highs this morning, driven there by a big Draghi jolt. Who's that? What's that? Well, Draghi, as in Mario Draghi, head of Europe's central bank. And today in Frankfurt, he took monetary steps that electrified markets, first in Europe and, for a time, here in the United States. He slashed interest rates to fresh record lows, nearly 0%, and announced some Federal Reserve-like bond-buying stimulus measures to boost the struggling Eurozone economy. But the Draghi jolt faded. Wary investors pulled back ahead of tomorrow's big August jobs report. Indeed, two unemployment numbers out today, unemployment claims and private payrolls. They were both weaker than expected. At the end of the session, the Dow down 8, the Nasdaq lower by 10, and the S&P off by 3. The dollar rose as the euro fell to a one-year low on those actions by the ECB, dipping below $1.30 for the first time in a year.
Despite today's modest sell-off on Wall Street, the U.S. stock markets are still hovering near historic highs. The American economy is growing, and the U.S. Federal Reserve is not only pulling back from its stimulus measures, but talking about raising interest rates. In Europe, things are completely different. The central bank there is trying to avoid a recession and is pumping money into the financial system to stimulate growth. Steve Leisman has more on two continents, two economies, and two divergent policy paths.
European Central Bank President Mario Draghi surprised markets around the world by announcing new measures to stimulate the beleaguered European economies. The euro plunged by 1.5% as Draghi announced the ECB was set to buy bonds to lower interest rates and cut the central bank's own interest rates, lowering one from 0.15% to a still lower 0.05%. and cutting another from a negative 0.1% to a more negative 0.2%. What's a negative rate? It means banks have to pay the central bank to keep euros on deposit there. Draghi suggested even more could be on the way if the current round of stimulus doesn't do enough to reverse the continent's flagging growth and declining inflation levels.
Should it become necessary to further address risks of too prolonged a period of low inflation, the Governing Council is unanimous in its commitment to using additional unconventional instruments within its mandate.
All this in stark contrast to Fed Chair Janet Yellen, who is facing increasing pressure to raise rates sooner. A report on the service sector today was practically near boom time levels. Unemployment insurance claims are low, and Wall Street is expecting another strong jobs report tomorrow for the month of August. While the two central banks move in different directions, the policies could be complementary, at least short term. While Yellen eases back the Fed's easing, Draghi is pushing on the throttle, potentially reducing the pain of a Fed course reversal. While Yellen likely next year will take action that could raise interest rates, Draghi's taking action to lower them. And it's had a powerful effect on not just European rates, some of which are below 1% for 10-year bonds, but also on U.S. rates. While a weaker euro will challenge U.S. companies, especially exporters, whose products could be somewhat less competitive in dollars versus euros, a stronger European economy will help the U.S. The downside could come down the road if Yellen needs to raise rates to fight inflation, but the ECB's actions make it difficult for her to do so. But that's a problem for another time. The immediate issue right now is Europe and avoiding another recession. For Nightly Business Report, I'm Steve Leisman.